Jasmine Murani for KTN News.
Now, as the country continues to grapple with unemployment, there is a mushrooming entrepreneurship culture among the youth. Young entrepreneurs are now being urged to incorporate bookkeeping for their accounts in order to secure their businesses. Jimmy Mbogo spoke to CPA Samuel Oyombra to get a better understanding of basic skills in bookkeeping.
Bookkeeping is the system where you put this information into an organized manner so that you are able to know for a particular period of time how much revenue did I collect and how much expenditure did I incur. Okay. Now, this information is arranged such that you are able to know what profit you have earned at the end. Now, this is the essence of bookkeeping: recording your receipts and also recording your expenses. Basically, in some books in your office, you list down your receipts according to the dates in which you received them, the cash, and where your money has gone to, whether it is in the bank account or in your pay bill account, and also your expenses. You list them down, and at the end of the period, you arrange this information in some manner so that you're able to know what has been my profits. So a business will need to buy a cash book. A cash book is basically a book where we'll be recording all your cash inflows and all our cash outflows. So one side of the cash book will record all cash inflows, and the other side will record all cash outflows, the cash that we pay. So when you set up a business, I want to believe that you will have a bank account as well. So every transaction, every money that you receive, you record. It could be that you receive it in bank. So the bank will credit your account, your bank account. But you in the office, you need to record it on the debit side, on the left-hand side of your cash book. So you record that today, I, Samuel Oyombra, has pumped in 10,000 into this business. So I record 10,000 shillings receipt from the director. It could be capital or it could be a loan I am giving to the business. So I debit the cash book. Then I wait to sell my product or service and I receive the money. If I sell it in cash and receive the money, I again record it in the cash book on the left hand side of the cash book. Received from Mr. XYZ for services rendered or for products supplied. Another 20,000 shillings. And then at the end of the day, I want to pay out electricity. Then I pay out the cash. It could be through a cash transfer into from my bank account. I record it on the right-hand side of my cash book. Money paid for electricity for the month of April or for the month of May, 4,500. Then I close the day. I wait for the next day. The next day, the same thing. It happens that way throughout the period. However, there are some times when you incur an expenditure, but you have not received money, you've not paid out money. You call it, you need to do something called accrual. You need to record that expenditure that you have incurred, even though you have not paid it. That one you don't record on your cash book because money is not moving out. So you record it in one of your ledgers. Expenses incurred but not yet paid for. Every transaction that you make in the business, it has to have two entries. We call it debits and credits. So if you pay cash out to pay for your liabilities, you will credit your bank, your cash book, and you will debit your expenditure. So in all these things, once everything is done and dusted, all your debit side and all your credit, all the entries in your debit side in everywhere, and all the entries in the credit side in all your books must be equal. Most often, lenders don't give that financing unless they study the financial performance of the business, how the business has been performing, where it is standing at that particular point in time, and how it predicts to perform in future with this new proposed funding. The lender will want to see that, and that information can only be generated from a properly kept books of accounts. One of the most common mistakes is it's called an error of omission. Some business transactions are omitted from the books of accounts. I've just mentioned one, you have incurred an expenditure, but you have not paid for it. It needs to be recorded, but some businesses think that they should not record it until they actually pay for it. Yet it is an expenditure for that period. If you mix your personal expenses with the business expenses, then you will not be able to determine the accurate profit, because some of your personal expenses will be treated as expenses of the business, and then the business will have more expenses than it ought to have, and hence less profit. And any third party looking at the statement of profits or loss will just note that this is not accurate. And if it was a lender, then they may be reluctant to give you financing if you present such profit and loss account. You need to be constantly looking at how you are performing. You don't need to wait until the end of the year to know how you performed. You need to review your performance every month and every quarter. How did I perform this month? How did I perform for the last 3 months? How is it looking up to now, 6 months after starting the business? And at that point, you are able to say, from the profits that I have made, let me pay myself. So the first mistake business may do is to try and think that they can do this by themselves. It will be very risky. So I would advise that they seek the services of a qualified accountant.
All right, now with that,